everyone, welcome back. It is Michael with Offshore Citizen, and today we are sitting here in the quarantine, lockdown type thing, and we're going to discuss with you types of companies. And this is, I think it's kind of fairly basic, but especially as you do things internationally, I think it's pretty important to understand. It kind of helps you to navigate when you're looking at these things. And I'm going to kind of translate for you a little bit of the language as well as the broader sense that some people don't necessarily understand as they're doing because maybe the terminology is different in their country, etc. So we're talking about types of companies, and loosely speaking, we're going to divide into what I would call the three major types of companies, and then those will help us to explore some of the details of other variations that may exist in one country or another, but maybe not in yours, and you can potentially take advantage of that. Okay, so first of all, the most basic thing that people are used to is a limited company, okay? A limited company means limited liability, and what that means is, historically, we've talked about this with a video on the corporate veil, is this idea that you have liability protection based on your investment into the company. So you're limited to, your losses theoretically are limited to what you've invested into that company, okay? That's the concept of a limited company. And all around the world, they tend to have some form of a limited company. So for example, in Spanish countries, such as Latin American countries, we tend to have an SA, okay? So whereas in places like Canada, etc., you may have the ending limited, which is kind of the most common. You'll see that's the norm in, say, UK and Hong Kong, etc. Sometimes they allow you to have variations. So as I said, in places like Canada, you can have Inc. or Corp. So these are all the same thing. An incorporated company, a limited company, an LTD, a corp, all the same thing, okay? We sometimes abbreviate and say corp or corporation, right? So that's the idea of a limited company. And a limited company can have multiple shareholders, and it is considered a separate legal entity, okay? This is the kind of the key defining point, meaning that it can go bankrupt, it can have its own credit, it can be sued, it can sue people. It is like a separate legal person, okay? The rights and responsibilities, in a sense, of a person go into the corporation. You can get into, people have different theories about, a corporation is kind of psychopathic and things like this. All that stuff aside, legally, this is the basic unit. So as I mentioned, in Spanish countries, you'll have an SA. That's kind of one of the most common variations that you'll see. If you're in kind of German speaking countries, you have GmbH, I believe is the acronym. In Netherlands, you have a BV. Okay, so these are all the same thing. It's just that translated to their version, all right? Now at the opposite side, you have essentially not a company, okay? So this is the idea of a sole trader or a sole proprietorship. And here there's often no specific registration. This is you acting as a company. And where this is distinct is that in the case of a corporation, usually the company gets taxed and then distributions are made to shareholders afterwards. If you're a sole trader or sole proprietor, then you're in a situation where your company income is your income. They're one and the same. There's not multiple people, it's just you. Your liability is unlimited, meaning that every debt that you take on, etc., is yours. It's your credit that's being used, etc. So usually it is a basic business best practice as you get past any small degree to set yourself up a corporation or something similar, as opposed to acting as a sole trader or a sole proprietor, okay? So that's kind of the other extreme. And this, again, in some form, tends to exist in most of the world, okay? Now, this brings us to the next part, which is a partnership, okay? Now, here you'll have various different forms of partnership. You have a partnership, you have a limited partnership, you have a limited liability partnership, etc. The most common that you'll see typically, especially in things like investment structures, in real estate, etc., are LPs, limited partnerships. And if you're looking at, say, a law firm, you'll see LLP, limited liability partnership. Okay, you sometimes see that maybe with accounting firms, etc. What's the structure here? The structure here is that, so the tax, you'll have multiple people who are members, right? Hence partnership, right? Multiple. And the tax, however, flows through to them, okay? Meaning that whatever income the company, say the company makes $1 million of profit, and say there's 3 partners, and say they're equal partners, or say there's 2 partners and they're equal partners. Well, that 50% of it gets added onto their personal taxes, and that's how it's taxed, okay? Very important concept. So it's this flow-through taxation is what I would call it. If you're talking about variations, so from a liability standpoint, a partnership, in theory, the partners would have unlimited liability, right? A limited partnership, usually you'll have a limited partner and a general partner, and there might be many limited partners. In theory, there could be many general partners as well, but usually there's one general partner and a bunch of limited partners. So this would be a common, say you're doing a real estate development project, this would be common. The general partner maybe raises money, is managing the project, etc. They have unlimited liability, means if something goes wrong, it goes to them. The limited partners simply participate by putting money in, and their risk is in theory limited to the amount of money they put in. So if the project goes bankrupt, if there's creditor issues, if they get sued, etc., it doesn't come back on the limited partners, okay? And then a limited liability partnership, the partners tend to have limited liability, okay? So that's kind of how it ends up getting set up. Those are pretty much, so again, for example, in Netherlands, you have a CV is basically a partnership, right? Again, in much of the world, you have some form of partnership, you have some form of this. Now, you could have other variations, such as a joint venture. A joint venture is essentially just an agreement, which is not so different from a partnership, okay? You can kind of have some stuff around it, and you'll have various ways that you'll do that. Now, you can get kind of on the far end, a more extreme version of a corporation, something called a JSC, a joint stock company, okay? And in a bunch of parts of the world, you will sometimes have a variation of a company, which is basically a public company, okay? And so, yeah, that's often a JSC. In German places, you may have an AB, things like this, okay? So you may get variations, but very, very often, it's simply a larger version, a more exasperated version of a corporation. And for our purposes, usually that's the case. Now, sometimes it's useful to have a JSC from a privacy standpoint, okay? So for example, if I'm in Georgia, what we'll sometimes do is we'll use, say, a JSC, or Bulgaria, you'll use a JSC. And the reason is that the shareholders' visibility is protected. So only the directors maybe will be visible in that case. So whereas normally in a normal corporation, you will see in public records who the owners are, who the directors are. Here you see only the directors. Usually it requires multiple people, often multiple directors. So it's a little more complicated. It's usually more expensive to form. Maybe it has higher paid up share capital, things like this. So, whether it's right for you or not, it's just worth noting that, hey, there's a JSC or some variation thereof. There is a corporation, there's a partnership, and there is a sole proprietorship, etc., which is sometimes useful from a tax standpoint. Okay, for example, here in Bulgaria, a lot of people would benefit from having operating as a sole trader, maybe in addition to having a corporation. Okay, all right. The next thing that we start getting into variations of that. So the most common ones are we start looking at the U.S. language, and the U.S. has particular variations that you're not going to see in most of the rest of the world. So, for example, in the U.S., you have an S Corp, you have a B Corp, you have a C Corp, you have an LLC. All right. So the corporation that I just talked about is a C Corp. Okay, that's the normal corporation as you might think about it. A B Corp is a not-for-profit company, and again, in some parts you'll have not-for-profit corporations. So for example, in Canada, they have a not-for-profit corporation, which basically there can be no share value to it, okay? So that's kind of some of the distinction. It's not necessarily, it's not charitable. It might not have charitable status, so meaning that you can't get a write-off for donating to it, and it may be subject to tax still, but it has kind of this different property that's not for profit, and therefore there's different consequences of that. Okay, so that's kind of the next little piece. An LLC, a limited liability company, which is super confusing for people, right? Because they would normally think, well, hang on, it's a limited company as opposed to a limited liability company, right? Actually, before we go into that, let's talk about S Corps. So an S Corp is basically being a sole trader, but with liability protection added on. So generally speaking, if you are somebody in the US who is getting set up as, you're forming a company, you want to be kind of the most efficient in terms of how you manage things, in terms of the taxes you pay, etc. You're not setting up a big organization, you're not bringing on investors, whatever, maybe you're a freelancer, maybe you're doing some online marketing, things like that. You're probably going to want to go with an S Corp. And there's some nuances in terms of how payroll taxes work, etc., that kind of define why that is, okay? But the way that it works here is it is not a separate legal entity, okay? So it has basically the tax treatment of being a sole trader combined with some liability protection. That's kind of the theory behind it. And so, in theory, it can go and it can have its own credit, etc. But it's going to have flow through taxation. Okay. Now, it does get a little bit dicier when you talk. We have videos on asset protection. We discuss this. The challenge with it is that if you're the only person involved, it's going to be much easier for them to demonstrate that, hey, look, this person is really responsible, and so we can come after them from a legal standpoint. So that's a whole other conversation to get into. But anyway, the whole point is, from a simplicity management, it's what we call the term in the US is what's called a disregarded entity. Okay, so a disregarded entity means that for US tax purposes, it's disregarded. They just pretend it doesn't exist. There was no entity there. There's only the owner and the income. And so although it's treated separately in terms of liability, although you set it up separately as a legal entity, from a tax standpoint, it's flow through, just like a partnership would be, basically, okay? Then you get into what we call an LLC. All right, so an LLC is probably the most common corporate form in the US. And this is because it's quite flexible, tends not to have as many complications in terms of how it's run, and it can be treated basically like any of these, all right? So an LLC can have a whole bunch of what they call members. These are effectively shareholders, but we call them members. And so they have a membership interest as opposed to shareholding, all right? But realistically, you can write, there's a tremendous amount of flexibility in terms of how you write up what's called an operating agreement. So a bunch of these will have different, you'll have articles of incorporation for a C Corp, you'll have a memorandum of association and things like this. Again, depending on the country, there's some different linguistics around how they describe it. You have a certificate of formation, a certificate of incorporation, things like this. Those two are effectively the same. The memorandum is typically similar to the articles. And so you get some variations in here. In the case of an LLC, you're typically looking at what's called an operating agreement. And this kind of defines how it should operate. And then you have these members, right? And you can, like I said, you can play around with how these members exist with a tremendous amount of flexibility. If you're talking about kind of moving to a public company, so you'll typically have a somewhat reasonable limited number of members of that LLC. And by the way, in the US, you may have an LLC, which you're using for some sort of a real estate project, et cetera, as opposed to, a partnership. It just depends on the situation, okay? Now, that is going to be something where you say, okay, great. I'm probably not doing that if I have a massive number of members. I'm probably doing it if I have a smaller number. And in fact, under the laws, if you get over 500 shareholders, then it's supposed to be a public company. So this was a big thing when Facebook was looking at going public, because there'd been a lot of kind of private trading and issuing of shares and things like this. And so they reached a point where they had to go and make a move because they had acquired too many shareholders, because individuals on the secondary markets were busy selling their shares, and it was increasing the number out there. So anyway, that's kind of a little piece of trivia. An LLC can, by default, will tend to be treated as follows, okay? If it's a single member LLC, it will tend to be taxed as an S Corp, okay? Meaning that it's flow through taxation. If it is a two-member LLC, it will by default tend to be taxed as a partnership, okay? If there are more members than that, it will tend to be taxed as a corporation. That being said, you can opt to have it taxed differently, okay? So you can have a single member LLC that you can check the box. There's some check the box rules in the US, and these apply particularly internationally. The way that it works is, because there may be a different corporate form in another country than there is in the US, there isn't necessarily equal standards in terms of how it's treated. And so a company can opt by checking the box to treat it as, whatever US equivalent. And so this was a really common strategy that was used, say, by companies like Apple and Google and Facebook and Microsoft and all these guys when they would have foreign companies. There were some rules called controlled foreign companies. We've got a video on controlled foreign companies rules, but they effectively had some rules whereby if you had companies in different countries and they were transferring money between them, that would trigger some rules. But because you can have a company treated as a disregarded entity, there's there is no transaction for US tax purposes. It's as though it's all the same pool of money. And so what they would do is they would form these subsidiaries and they would check the box to treat them as transparent, and then there was no transaction, and that would avoid this problem. Okay, so this was one of the ways that they would get around those rules. Anyway, getting back to the point. The point is you can treat it as, whatever it is that you want, in theory, in terms of those. So you can say, okay, obviously you wouldn't treat it as a partnership if you were just a single member, but you could treat it as a corporation. And usually that's not the case. Usually you would want to treat it in terms of flow-through taxation, but you may not want to. There may be some reason you say, hey, look, it's easier to set up an LLC, it's easier to manage an LLC than a C Corp, but I want to treat it as a C Corp, have it taxed separately, and then receive distributions from it, basically the equivalent of dividends, but the term would be slightly different. So that's that. The last thing that is perhaps interesting to learn about is there's something called a series LLC in the US. In kind of UK law, there's something called a protected cell entity, which is more or less the same thing. And this is, in theory, a really good piece of legislation. It doesn't exist in all of the US states, but it exists in some of them. And you would use it, for example, for real estate holdings. It would be very, very common. Basically what happens is you have one legal entity and you can form multiple series. These are effectively sub-companies within that one company. Now the reason you would do this is because you want to simplify your tax or your filings in general, but you want to have liability protection separating all of them. So you would put each separate property into a separate series. That series then isolates the liability. So say somebody falls and breaks themselves, or breaks their leg or something that breaks themselves, on your property, they can sue, but the only asset in that series is that one property. It doesn't spill over into other properties and take your whole portfolio down, right? So whereas in other places, what you would do is you'd say maybe put in 5 properties into one company, then the next 5 you're gonna put into another company, and so on and so forth to try and split this liability up. It just makes it much easier because you don't have to say, oh, hey, I have one LLC per property, and I have to file for each of them separately, and I have to do annual renewals for each of them separately, and all this, it just simplifies it a lot. And so protected cell entity, same basic idea, or protected cell company, right? So various different British common law countries will have protected cell companies. And it's a very cool thing. The problem with it is banks don't really understand it, and so you have this little bit of a challenge. I guess the last thing that we could talk about is a special purpose vehicle, SPV or SPE. You're gonna see this in the news a lot. It was probably made famous by Enron. So an SPV can be various different types of entity, but basically it has no beneficial owner is the idea. Again, in practice, when you go to a bank, you have to provide beneficial items. So it's, some of these concepts are a little bit, the law and the execution vary somewhat, but it allows you to essentially pool resources together and separate liability out. So Enron, what they would do is they would go and they would throw a whole bunch of liabilities into these SPVs, move it off their own balance sheet, so they could look like they had more assets and less liabilities, even though that wasn't the case. Most recently in the news, which you may have seen, is they did this through the Fed. The Fed is not allowed to get involved in buying, say, corporate bonds, but they wanted to do that right now, given kind of all the need for stimulus, et cetera, in the economy. And so the way they did that was they created an SPV through the Treasury, and then they fund that SPV, and then the SPV goes and buys it. So it's, fancy legal ways of trying to get around the rules, which, can be pretty useful. Most of you will probably not be in a situation where you need to use SPVs, but hey, it's an interesting thing to know about. So anyway, that's kind of like an overview about different company types. Like I said, they vary from country, and you'll particularly get into these complications when you deal between them. So for example, say I have an LLC in the US, there is no LLC in Australia, there is no LLC in Canada, there is no LLC in the UK. So how does it get treated for tax purposes, right? The way they do it is in Australia, they treat it as a partnership. In Canada, they treat it as a corporation. In UK, it's a little bit more complicated. There's some court cases there that kind of have laid out what goes on. Anyway, the whole point is just, it both gives you some advantages if you play it well, but also can expose you to some bad sides of things if you don't play it well. You can imagine if you had a US LLC that you treated as a C Corp in the US, but it was owned by an Australian, and Australia is treating as flow-through tax, but the US is not, that could be negative. And the flip side, if you were to say, look at Canada, you say, okay, maybe I'm treating it as flow-through from the US standpoint, but I'm not, but Canada's treating it as a corporation, and this can make differences in terms of what write-offs you can claim and how you can pull expenses back and forward in time, et cetera. So anyway, the point is, it's something to worry about. If you're in that situation, we're happy to consult with you about it and talk to you about what you should do best in your situation. And yeah, if you have questions, reach out to us, visit our websites, offshorecitizen.net, offshorecapitalist.com. We got lots of articles, lots of other videos. Like this video, subscribe, and I will see you guys on the next video.